Good evening, everyone. This is Terry Kashat with Connect Loans, and tonight we're going to talk about the return of the ARM. So number one, what is an ARM? It's ARM, which stands for Adjustable Rate Mortgage. Again, that stands for Adjustable Rate Mortgage. And the way it works is you start off with about, on average, a 0.5% better interest rate than whatever's going on right now for a short fixed period, call it 5 or 7 years, and then the interest rate will begin to adjust with the market. So let's say in the future the rates are up, the rate will start to adjust up. If in the future the rates are down, your interest rate will start to adjust down without even having to refinance. So it takes you to point number two. You may be asking yourself, why would I do this? Why would I do an adjustable rate mortgage? And if I'm gonna get you to a 7% instead of a 7.5%, that's gonna save you anywhere from $200 to $400 per month, and the rate is fixed for 5 or 7 years. So during that 5 to 7 years, you have no risk. Now, what could happen during that 5 to 7 years? Rates could drop, in which case you refinance to an even better deal. Or if this is your first time home, if this is your second home because you're starting to have kids and you just want to grow, and you know you're going to be in the current home for no more than, call it, 7 years, you're taking little to no gamble by taking this adjustable rate mortgage, saving your family $200 to $400 per month, and you would have either refinanced or moved out of this home before your rate started to adjust anyways. Which takes you to point number three. Who's a candidate to do an adjustable rate mortgage? Who shouldn't do an adjustable rate mortgage? There's really only one person I would say that shouldn't do an adjustable rate mortgage. Two people. One is a person who just doesn't like to gamble at all, even though I'm creating a little to no gamble situation. Or two, you're gonna be in this home for a very long time. You're gonna be in the home for a long time. You wanna act like rates are not gonna drop. You just wanna get the lowest secure rate you could get possible. I'm gonna advise that you pay points, buy down your rate a little bit, and let it stay fixed. And if rates drop, refinance. If they don't drop, you got yourself the lowest rate you could get. Which takes me to a bunch of other people who should be doing an adjustable rate mortgage. I left an example earlier. First-time home buyers, you're gonna be in your home for less than 5 or 7 years. You know, your family's starting to grow and you already have the idea that you just need a bigger home, but for the next 5 to 7 years and you plan on moving to another home. Those examples are taking little to no risk. The third example is just a person who likes to gamble. And you're gonna say, let me get the lower rate now. I believe rates are gonna drop and I'll refinance at a lower rate, et cetera, et cetera. Today's adjustable rate mortgages are not our parents' adjustable rate mortgages. Prior to 2019, before their record low interest rates, I was writing adjustable rate mortgages for my clients all the time. And the examples always played out to where it turned into no risk. My client either bought another home and therefore the original mortgage didn't matter anymore, or we ran into a situation where rates got better and we refinanced anyways. So, should you want to find out how an adjustable rate mortgage would work with your mortgage, touch down with Connect Loans. We'll review a fixed rate and adjustable rate, and we'll run the risk. We'll run the little to no risk scenario and tell you what would happen in the worst case scenario so that you can make a confident decision on whether you should be choosing an adjustable rate mortgage. We'll see you soon.